Hello, welcome to the episode in this week's economy with Dr. Vance Ginn. I'm your host, Dr. Vance Ginn. We've got a lot to talk about. Today is April 7th, 2023, Friday, Jobs Report Friday. And so I want to talk a lot about the U.S. Jobs Report, what's in there, what you should know, what you should expect for the future, things of that nature. That's number one, the Jobs Report. Number two, I want to talk about the banking crisis. I've been on a couple of shows here recently with Neil Cavuto on Fox Business, Kevin Hogan on NTD News, talking a lot about this, but I also want to go over a little bit of the Fed's balance sheet. So that's number two, the banking crisis. And number three, what's up with the states? I want to talk a little bit about what's happening in Texas with their budget that they passed in the House anyway yesterday, but also some of the school choice efforts that they're working on, and then talk about a little bit of Louisiana, as I'm working a lot in that state as well, and then give you a little bit of a preview of some things that are coming up. So those are the big three things today. Let's get straight to it. So the jobs report came out today. And one thing I do want to mention is if you hadn't watched the Let People Prosper show this week from Tuesday, I've got a great guest, Annie Spillman, who is the NFIB of Texas state director here in Texas. And we talked a lot about businesses, the need for regulatory reform, tax reform, and things of that nature, but how small businesses are really the backbone of job creation across the economy. So if you haven't checked that out in the Let People Prosper show, please do so. But on this jobs report for March 2023, which comes out the first Friday almost of every month. That's what we're looking at here. And what we see, kind of the breaking news, was that the job growth totals 236,000 in March, which is a net number. Near expectations as hiring pace slows. It was about 240,000 was the consensus estimate. So it was right about that amount. But we have seen kind of a slowdown in job creation. January of 2022, there were a little bit less than 400,000. And we've seen a slow, steady decline. Although in January and February of this year, we did see quite a bit, over 400,000 in January, over 300,000 in February, and now 236,000 in March. So we're seeing some slowdown happening there. And I think we'll continue to see that. When you look at some of the other measures that are out there, because you're going to hear a lot of reports about the job creation is slowing, which is true. The economy is slowing, which is true. I think we've been kind of in a recession for a while. And so now we're starting to see the boom and bust cycle, the bust happening, where the labor market is usually, most cases, is a lagging indicator of the recession and everything else. You have business investment that slows down. Employers don't want to just go out and start firing people, although some would like to think that, but they don't. They take a while. They don't want to hire new workers and things of that nature. And so then they'll start letting go of folks as their profitability and their losses start piling up, right? And so I think what we're seeing is a lot of that now, especially the tech firms, the financial firms, which we'll talk about here in a little bit. But there are these indicators that are showing us some big slowdown throughout the economy. But if you look at the labor force participation rate, especially for those that are 25 to 54 years old, what's called the prime age working group, which I happen to be in. Probably many of you are, maybe as well. And so what you look at is that the prime age labor force participation rate, which is a good measure of those who are really in the labor force, the most productive years and everything else, is at 83.1%, which matches about where it was in February of 2020. It was at 83%. It had moved up to 83.1% in January of 2020. So right before the recession, we're finally back up to those levels of that group getting back to work, which is important. And I think we'll see more of that here soon. The overall labor force participation rate isn't quite back up to where it was. And so that's where we still see, are some of these people going to come back in the labor force and things of that nature. But at least from the prime age, it looks good. But I should note that after the financial crisis of 2008-09, we were about this area too of 83% throughout the 2000s. It took a long decline there. I'll put some links in this in the show notes page at vanceginn.com, or you can find them at vanceginn.substack.com. But you'll see a long decline about to 81%. Then it started going back up, especially after the Tax Cuts and Jobs Act, the deregulation under the Trump administration, and then it fell quite a bit. But if you go back to 2000, it was around 84%. So we're about a percentage point below where we were then, which would be, millions of more people in the labor force had we got back to that level. So that's something for us to consider. And then if you look at the employment to population ratio, which is another good measure for the prime age group and just the economy overall, it's at 80.7%, which is right again back where it was in February of 2020, which is a good sign. But think about going back to 2000, we were closer to almost 82%. So we're a little over a percentage point below where we were then. If we could get back to that level, I think it would be good, as we need more people in the labor force and things of that nature. So some good signs. The unemployment rate's at 3.5%, which we talked about isn't a great measure, but that's that measure that's out there. But average weekly earnings continues to disappoint. Average weekly earnings were up only 3.3%. And with inflation running hot still of about 5%, you take the difference between those two, we're still running about 2 percentage points below just inflation for private sector employees across the economy. So it's not a good signal over there. And so that's the 24th straight month where year over year, average real wages adjusted for inflation are declining or down. 24 straight months. So essentially 2 years, basically since the Biden administration came in and passed the American Rescue Plan Act and everything. So I think that there are some highlights here that to look at with the jobs report. If things are slowing, the labor market still has a ways to go of decline, and we're seeing that we're not fully back to where we were. So there's still a lot to want. And look, Americans are still hurting because of all this inflationary pressure. So number two, what's up with the banking crisis? So we know we had this banking issues with Silicon Valley Bank, Signature Bank, some other banks failing. They had a lot of funding that was going to technology firms. They were invested in ESG, environmental, social governance sort of nonsense that's out there. And that's okay if they were able to get returns, but they weren't. And ultimately, they had to fail. A lot of it was due to their treasury securities, their debt portfolio that they had. When those prices went down, it reduced their assets. And look, I was on Fox Business this week, actually yesterday, with Neil Cavuto, talking about the banking crisis, talking about the jobs report and how we still have a slowing economy. And I was also on NTD News with Kevin Hogan talking about this as well, where, Americans really need to make sure you're diversifying your portfolio. This is another great example to do that, whether it's deposits at banks, because remember, you're insured up to $250,000, although the government looks like they want to insure everyone now, no matter what your amount of deposits are, which is a huge amount of moral hazard and risk that's going on throughout the banking sector, which I think is going to contribute to slower growth, less risk taking and things of that nature, or maybe even more risk taking by some, which means we're going to have more failures out there. And look, I think we need some failures. I mean, failure is important for us to learn and make sure we overcome those mistakes of the past. But it's when government forces it upon us that makes it even worse over time. So I think those are going to be something to look at. And I'll put both of those videos of my interviews up on the show notes page, so you can make sure to look at that. The other thing I was looking at recently is the Fed's balance sheet. The Fed's balance sheet, which is, I think, the best picture of what the Federal Reserve is doing, not just their target interest rate, which is 4.75 to 5% now. That's important, but their Fed's balance sheet is really where the money is going out in their economy, and they have a lot of credit that they're issuing out there for treasury securities, mortgage-backed securities, lending to financial institutions, and so forth. And all these things, what they do is they manipulate the free market, right? This is not free market sort of outcomes. I think if we have something that was maybe backed by gold or silver, or a free banking system is my preference, but something that allows for the market to work instead of the Fed manipulating those markets, that would be a better situation. But that's not where we're at today. So the Fed's balance sheet was at $4 trillion before the pandemic. They started to ramp up that because a lot of banks were having issues and things of that nature. And we were shut down, right, for way too long. Just in general, we shouldn't have been shut down. But it went from $4 trillion, their balance sheet went to $4 trillion, their assets, up to $9 trillion, right? So a massive increase, more than doubling of the balance sheet. No wonder we have so much inflationary pressure, inflation that's out there, too much money chasing too few goods. But recently, since April of last year, April of 2022, when they hit the peak of $9 trillion, it has been going down. The Federal Reserve has been cutting their balance sheets down to $8.3 trillion. So it was about, a $700 billion decline in their overall balance sheet of around, 6.5%, 7%. Well, since the Silicon Valley Bank and all of that stuff happened with the banking issues, the liquidity, what they consider to be a liquidity crisis, they added about $400 billion more dollars to $8.7 trillion. So $400 billion increase in their balance sheet, which adds more inflationary pressure. And then just this last week, it went back down to 8.6. So it went down to nearly $100 billion. I think it was about $75 billion overall. So we're seeing maybe we're going to go back to normalcy. I've been saying for a while when the Fed should be cutting their balance sheet more. The only thing that they have control over is inflation, not the labor market and everything else. And so they really need to focus on inflation. So they've got to cut their balance sheet more to get that liquidity out of the marklepalace. And ultimately, we need more supply side, pro-growth policies out of the Biden administration by deregulation. We need some, spending restraint, spending cuts would also be pro-growth. And that would allow them to also have some tax cuts and things of that nature to really get people back to work. which goes back to the labor market that we talked about earlier. So that's the banking crisis. And then finally here, I wanted to talk about a little bit about the states, what's going on. I follow a lot of that, work with a lot of entities, think tanks on state policy as well. And one of the things that I've been, looking at is the amount of school choice that's happening across the nation. It's been quite remarkable, the school choice revolution, where you have Arizona, West Virginia, Utah, Arkansas, and Florida all passing some form of what I think is nearly for universal school choice, where everybody who wants one can get it, and they can use those funds of an amount of, maybe it's $8,000 or something like that. Well, Texas also has a bill, SB 8, which was passed out of the Senate yesterday. And it's a good bill. It's an improvement from where we're at today, no doubt. It's an ESA bill of $8,000 where parents can be empowered to take their kids to the school of their choosing. But the eligibility criteria is restricted. It doesn't include kids that are in private school now or homeschool, which is, I think, between 500 to 750,000 students. That's a big range there, but it's a pretty large number of kids that are outside as well. About 5.3 million kids are within the government schools, right, quote unquote public schools, but you have a lot of them that are not. Well, you have to be within SB 8, the eligibility criteria. You have to be in public school, or you have to have 90% of it been in public school in the prior year, or entering pre-K or kindergarten to be eligible. So that means that if you're in first grade, second grade, third grade, or so forth, if your child is, you're not going to get access to these funds. And not only do I think that this is a bad policy in the sense of we need everyone to have access, but it also creates these discrepancies, which I've tweeted about here recently, that, some people are going to have the money and some people aren't. That also means families are going to have more income to do other things than others, and tutoring and things outside of the classroom, because it's not universal, and it's going to give some kids more opportunities than others. Everyone should have the same opportunities, which is why we should have universal education savings accounts across the state. Yes, there will be a little bit of cost to it, but Texas has a ton of money. We have $33 billion in surplus. A lot of that should be used for property tax relief. But the other big part of this should be universal school choice. And I think that would create an opportunity for Texas to not fall behind like these other states are already moving forward. Other states like Louisiana and others should also be passing universal education savings accounts, because if not, there's going to be more of a flood to people to go elsewhere, but to really meet the needs of their kids. And then finally here, the Texas House passed their budget yesterday. I think the budget was too big. In my view, it was not a conservative budget. It was more than population growth plus inflation. When you look at appropriations to appropriations, it's also well more than a frozen budget. So this leaves a lot less money available for property tax relief, to put money back in the pockets of people. Because remember that excess collections of taxes is just, taxation is theft in many sense when it gets above a certain level. And I think this is too much. They have too much money. And so that money should go back to the taxpayer overall. And so I hope other states will be doing more of that, which we have seen, right? We also have not only do we have a school choice revolution, we've also got a flat tax revolution among the states. And I think hopefully a responsible or conservative budgeting revolution across the states. And so Texas needs to make sure they lead the way before this session is over. And then finally here, I know I said finally, but this is really finally, Louisiana. I wrote a piece for Pelican Institute for Public Policy talking about how can Louisiana reduce dependency on the federal government by supporting prosperity. Louisiana ranks third with 44% of their total funds of their budget coming from the federal government. A lot of that's because of natural disasters and things of that nature, but the majority really is coming from these social safety net programs like Medicaid funding from the federal government, but also SNAP like food stamps and TANF and other funding that comes from the federal government and then the state administers that. A little bit of state funds are used as well in some of those, or portion of them. But I think the big key here is not to think about how much more we can have in social safety net funding and people on these programs, but how to get them off the programs. And that's why you need to cut spending, reduce taxes, get a broader base, have a flat tax, eventually eliminate income taxes altogether, to really have, and also cut regulations to make sure that you have the most economically viable, vibrant economy overall so people can flourish. And so I think when you take into account what we talked about today, with the jobs report being kind of weak, the banking crisis that I think will continue to hurt the economy, and some states are moving forward in a good direction, but we need more reforms to make sure that people can prosper. I think we've got some good opportunities here to continue to talk about these things as we go. So thank you for joining me today. Please leave a 5-star rating and share with your friends and family. And until the next time, let people prosper. And this has been This Week's Economy. Have a great day.